Hello, everyone. This is Paul Feldman, president, founder of Insurance Newsnet. I'm here today with Paul LaPiana from MassMutual. He's the head of brand, product, and affiliated distribution. And I'm really excited to have you here today.
Well, we're excited to be part of this. Thanks for having us and looking forward to the conversation.
Absolutely. So, Paul, how did you get into the industry? That's always one of the most fascinating subjects that I cover with my interviews.
So I would say that I was the first person in our family to graduate from college. I come from a blue collar, let's call it tradesmen and women type family, pipe fitters, electricians, etc. So when I graduated from college in 1992, there wasn't a robust job market. And my college roommate, his father was a general agent or managing partner back in the day with Equitable. And so Dave, who is still with Equitable 34 years later, was going to be a financial advisor. I literally did not know anything about what being a financial advisor was. So I ended up getting my first suit at 3 Day Suit Broker, went in for the interview, and before I knew it, I was hired as a financial advisor or agent with Equitable. Very underwhelming from my parents because they were not excited. My dad's literally, his comment was, first of all, you're not going to sell me anything. And secondly, anytime you want to get in a union, I can get you $6.95 an hour and full benefits. So that being said, Dave Cahal and I ended up cold calling our way into the business. At nights, we were cold calling baby leads, people that just actually had new babies, mortgage leads, people that just refinanced or bought homes. And during the day, we were knocking on doors of small to medium-sized businesses for any kind of 401k,
Wow.
SEP plan, and or health insurance that people were trying to put into their companies because the top advisors at Equitable were all focused on the corporate market. So I actually jumped in and was an advisor for 8 years before somebody asked us, Dave and I, to leave our practice and get on the corporate side. But that's the journey. So spent a lot of time, grinding out, starting a business as an advisor in the industry.
That's a fascinating road trip. How long have you been with MassMutual?
So I've been with Mass Mutual for 9 years, but if you looked at my years of service, it would actually say 23. So I was at Equitable as an advisor for 8. Our mentor, who was our managing partner, tapped us to start third-party distribution for Equitable AXA in
Mhm.
1999. So we gave up our practice to do that. I followed some of those folks a couple years later to start a third-party business at MetLife, and then was at MetLife for 15 years.
Mhm.
About 10 of that was on the wholesaling and distribution and third parties. And then I was asked to lead the career agency system at MetLife in 2012, and then did that for about 4.5 years. And as you know, when MetLife made a decision to spin off their retail business, which is now Bright House, the first shoe that dropped was they sold the career agency system, and they sold it to Mass Mutual in 2016, and I joined the company in 2016. So obviously carried my years of service, but actually have been at Mass Mutual for 9 years, and it's been great.
So tell me a little bit about your perspective on career agents and independent.
Yeah, so I would say spend a lot of time in both. And when I think about the need for career distribution and independent distribution, and we have this philosophy here, and we did in our prior world, you can only get to so many consumers through your career agency system. And if you have 6,000-ish advisors, you're serving a lot of clients, but there's a lot more people in this country in need of protection
Mhm.
and accumulation and retirement income. So third-party channels and the right third-party partners are a valuable way to reach those, other consumers that are doing business with those advisors. So I think both channels are awesome and needed. When I think about career advisors, one thing is it represents And ours are entrepreneurial and supported independence, and we'll talk about that later. But it represents the brand of the company, and it is the individuals driving the advice and guidance, and then using the product manufacturer's product to deliver the solutions and recommendations. And sometimes it's ours, sometimes it's other carriers and insurance companies and products and asset managers. But what I love about Career is there's a loyalty, there's an active feedback loop. They're the ones that are delivering the advice because it is about advice, it's not about product. And there's a really good cross section of consistent flow, but also business mix for your manufacturer. So ages, face amounts, types of products. So that's what you love about Career is they want to do business with you, and they're going to give you consistency and good mix for your profitability and risk, etc. On the third party side, obviously that allows you to grow because
Mhm.
you're reaching more people. I will say the positives of that, if you're working with the right partners, is there is a value on the relationship, the brand, the financials, the value prop that you bring with your wholesaling team, your product portfolio, your underwriting if you're in life insurance. And there's somewhat of a stickiness there. And it provides you with that growth, and it allows you, again, to get to more consumers, which is awesome. The challenge sometimes with third parties is you do play a little bit of the spreadsheet game. At the end of the day, if
Mhm.
you're not on the top, whatever, one, two, or three on a fixed annuity crediting rate or a cap or participation rate, or your term rates or your UL rates aren't in the top, five or seven, you fall to the bottom of their pecking order, and the volumes are volatile. And it puts a lot of pressure on always being the sharpest on the product and
Yeah.
underwriting if it's life insurance, and that's not always possible. Now, what I do like about having both channels, it provides not only the growth, additional feedback loop. It allows you to keep your ear on the ground. And if you can provide the growth and you can address the, let's call it asks to a certain extent, still managing profitability and risk, it makes everyone better, right? You are sharpening your product
Yeah.
portfolio, you're sharpening your underwriting portfolio, you're sharpening your ease of doing business value proposition. So they work really well together, but there's some puts and takes, from both channels.
So, one of the challenges we have in the industry, and I really love to hear your feedback on this, is getting new people into it.
Yeah.
And because you have the career channel experience and the independent, how do we get more people into this industry?
So it's interesting. I've been able to, go to a lot of industry forums over the years, being in the role I'm in and some other roles. And the one thing that I am concerned about, and I know you are with the question, is right now the industry's trading on EXP advisors.
Yeah.
And because not a lot of career agencies exist, and as you know, that has been a fuel for new recruits into the industry, so new people coming in. And because of some of the changes in the wires and banks that have not been as focused on inexperienced recruiting, it is a very expensive investment, but it is an investment. This is a concern that we have and I have. And if you couple that with the need for advice and guidance going up and people retiring from this industry, and you've seen some of the research that like one third of the active advisors will be out in 10 years, there's a mismatch between demand and supply. So when we think
Yes.
about it as a career agency, we are very fortunate to still be in the affiliated distribution game, and we appreciate our partners at Northwestern, at New York Life, at Equitable, at Guardian, because we're doing both. We're recruiting new to the industry,
Yeah.
and we're also recruiting experienced advisors to the business. So when we think about the inexperienced advisor, the one thing that we're changing in our model over the last couple years is we are focusing on fully licensed advisors. No longer is it just life insurance and annuity. It is
Hmm.
life insurance and annuity and investment product licenses. And what we found is when we bring those folks in with fully licensed, you have a more committed new person, either that's
Oh,
new out of
yes.
college or career
Yeah.
changer. You put proper training around those individuals, you see productivity rates go up, you see retention rates go up. And as you and I know, retention in the industry is like 9% after 4 years. And we see it closer to like 30 to 35 if they're fully
Wow.
licensed. And then
Yeah.
the benefit of that is they're also being able to serve clients in a more proper way versus just selling the insurance and annuity products. They're thinking
Yeah.
about things a little more holistically. The other thing we've been doing with inexperienced hires is we are, where we can, is strategically hiring new advisors to existing teams. As you think about our aging population of advisors and the need for succession planning and the need to expand their scale of their practices, bringing in junior advisors is really important, but it also works really, really well for the junior advisor because they've got coaching, they've got mentorship, they've got immediate access to clients in the book of business. And it
Yes.
also helps the senior partners deliver on the promises that they made to all of those families and individuals along the way because they needed to survive in the business 20, 30 years ago. And now you have people servicing them and providing opportunities to actually provide the right solution. So, what we've seen with team based advisors, productivity up, retention up, which is awesome. I think
Yes.
the other things that we're actually working on is lead generation, as you and I know. And I mentioned cold calling. The hardest thing about this business is
Yes.
getting in front of people on a favorable basis. And that's why retention's 9% after
Yes.
4 years, because it's a hard task and a lot of people aren't willing to do what it takes to get there. We have a lot of leads coming through, either through our branding efforts, our marketing efforts, as well as our in-force books of business, either at the national level or at the firm level. So we're layering on some technology, data analytics to be able to look at propensity to buy, next best action, and getting those people in the hands of the right advisors so that they can serve them, which has also been really good. And then the last one, which we're not landed on yet, but we are looking at different models, is just how we compensate new people coming into the industry is still the old school way, which it is full commission. And as you know, if you've got a career changer, 3 kids, a mortgage, like that doesn't work, right? So, how do we take that investment and provide more salary based options to get people settled into the transition of the new career as they start to get into more of a, let's call it fee based and or commission based income stream. So we're working hard at it. I don't think we've got all the answers, but we're looking at bringing like 12 to 1500 new into the industry every single year as part of our plans.
That's impressive.
So when you look at their product mix, we do, let's call it about 650 to 700 million of life insurance through those doors of our career
Wow.
agency. So it's about
That's huge.
90%. It's huge. About 90% of the company's life insurance comes through that organization. That organization does roughly 12 billion, 10 to 12 depending on the year of annuities, but we as a manufacturer only get about 40 to 45% of that depending on the year. So let's call it 4.5 billion because we have open architecture. So they're selling our competitors because they've got products that are, in the best interest of the situation they're sitting in. So when you look at annuities, it represents about 15 to 20% of our manufactured annuities. And then when you look at disability, it is roughly 95% of our fully underwritten disability insurance. And then obviously, wealth management is a huge part of our career
Hmm.
organization. And we're doing roughly $40 billion of new sales a year, but you're seeing kind of like that 10 billion, 11 billion of net flows of investment assets. We've got around 300 billion under management. So that's career. So now when you move to independent, it's a little bit of the reverse. They're a startup last couple years in life and DI. So life and DI, our MMSD channel is doing roughly 10% of our life insurance business and 5% of DI, and we want that to grow. On the annuity side, they've got scale. They're doing the 80 to 85% of our annuities through specialty distributors, IMOs, and broker dealers.
Is that mostly through Mass Mutual Ascend, or are you guys
So,
do
so
you
a
have a
great,
different? Is that just completely different?
so it's both. So
Okay.
when you look at Mass Mutual Ascend, they're doing, let's call it 40% of the 23 billion as a manufacturer.
Hmm.
The 60% is on Mass Mutual paper. So think about, IMLIC 50 state paper. Um, and so when you think about MMSD, they're selling our third party, they're selling the Ascend product line, and they're selling the IMLIC product line through all of the specialty distributors, independent broker dealers, and some of the wires. So they're, most of the scale in annuities sits in MMSD and Ascend.
So one of the things that I think that is the most undersold product in this country is disability insurance. And you guys do
Mhm.
individual disability insurance. Why aren't more companies doing it? Is it hard to do?
So it's interesting, and we were talking about this the other day at Rogers leadership team meeting. The disability industry has been a very slow growth and very, let's call it, it's been kind of the same for years. It's around a 500 to $600 million business. It is a different liability that
Hmm.
many, manufacturers aren't in and aren't comfortable being in. And there is, a small subset of carriers that have dominated that market for years. And we've been a number 3, 4 player in disability with like, let's call it 10 to 12% market share. Now we have individually underwritten disability, non-can. We also have a multi-life, so think of guaranteed standard issue for the executive space. And then we've got things like BOE, business overhead expense,
Hmm.
as well as buy sell. So we've got a full suite. Now, what is the challenge is distribution has been a challenge in disability. So what you've seen over the years is it's been concentrated in specialty distributors that have focused a lot of their time in the medical and dental areas, right? And so what we haven't seen is a broader base of sellers, meaning financial advisors, selling it to beyond the dental and medical space to white collar and even gray collar, blue collar executives, being white collar, and then blue collar type workers. And one of the issues that we faced, and we had it in our prior world and we have it here, is there's a fear factor for advisors with disability because it crosses the threshold into a lot of health issues.
Yeah,
And so a lot of times advisors, and it's one of the most important things that you could do in a holistic plan, but
absolutely.
they don't want to mess up. If something goes wrong because you have a shoulder issue, a back issue, there's an exclusion, and the client gets disgruntled, they don't want to lose the assets under management. They don't want to lose the life insurance, case. So they put that off and they actually sometimes don't address it. And so one of the things we are working on, it's not only about the product, it's about getting people to understand the reason why you have to put this in as a foundational part of a financial plan. And if you say you're doing financial planning and you've got credentials after your
Yes.
name, you got to be doing disability planning for your clients. And if you don't like the conversation, have somebody on your team that does do it or partner with somebody that knows how to do it.
I love the fact that you talk about a team because teams are the most successful in real estate.
Yep.
And we are kind of late to the stage on that. I mean, how do you build a team? How does an advisor go from just being a solo practitioner to building a team? What would some of the steps be for you?
Yeah, so I would say there is a lot of different derivatives of how you actually, build teams. We have a group of resources working with our local firms to actually help advisors sort through it. So I think one thing that we've seen work really well is you've got expertise that is differentiated by a couple partners, right? So if you and I were building an organization together and you had the investment management skills and expertise, and I had the insurance and annuity expertise, it works really, really well to put complementary skill sets together so that you can deliver on what we've been talking about, which is holistic advice and guidance. So I think that is something that we see a lot of people building around. The other thing that I would say about building a team, and I was part of one for 8 years, you have to have trust in complete credibility with the partners. You also have to have the same work ethic and have to have a common vision and a common objective with the team, because if that is not aligned, those are things that actually can get off kilter. I think the other thing people got to put on their mind is it's not about compensation. It is about delivering the best outcomes for clients and scaling your business. And I would say compensation splits and who's getting what also creates some issues with advisors, and that's a problem. I think the other thing that you have to do building a team is you got to also have support staff that is supporting advisors, whether that is product expertise, that is investment expertise, that is operational expertise, that is client relationship managers, so that the volume of the practice is being taken care of by people supporting the people that are actually delivering the solutions and or acquiring new clients or practices to actually build the enterprise.
And that's fascinating. Let's talk about product.
Yep.
What's hot? What do you see as the future for Mass Mutual?
What I would say is being a mutual company, we are very committed and we love the value proposition of whole life, participating whole life, and we want to
Still a
continue to make
classic.
sure,
Yes.
right? We want to make sure that our advisors in our career system, affiliated advisors, and folks that sell us in third party appreciate and understand the value that that product really brings to the end consumer or the business owner or the trust for the next generation. So I'd say that is a product that we are always keeping competitive and investing in because we believe in it and it's important for us as a mutual company. And that's the way we reward our policyholders for all of the latitude they provide to us in investing in our business. Now, that being said, staying with life insurance, our affiliated advisors do sell a fair amount of VUL down the street. They do sell a fair amount of UL down the street. And those products are typically VUL, a lot for accumulation, right? Overfunded and looking for retirement income with some tax efficiency. And UL, a little bit different, cheaper price point than whole life, focused on IRR on death benefit for wealth transfer. So we are looking in the life insurance sleeve to continue to appropriately support and grow whole life, but bring some adjacent products out to give us a shot to earn some more business with our affiliated channel because the business is happening through VUL and UL, and to give our third party channels a product that they can look at us for because they're used to selling it, right? That's what they've sold a lot in those third party channels. So I would say that is the life insurance journey. When we look at annuities, we are bullish on the annuity market because aging population, right? People undersaved for retirement. A lot of people having to go more at it alone because DB shift to DC and questions around government entitlements. And what is a product that actually can help with efficient accumulation and guaranteed retirement income? Is annuities. And what is the macro trend in the country? aging population and people not going to get to the finish line unless they use some of these products. So we are very bullish also on having a solid annuity franchise. That's why we did the acquisition of Ascend, and that's why we've done some things on our balance sheet with our existing annuity portfolio. So we've done things to enhance our fixed annuity portfolio to compete there. That's been very nicely received as we've seen interest rates on the short end of the curve come up. We've made some enhancements to our income annuities so that we can compete more favorably. It's a small segment of the market, but provides a lot of value for consumers. And then we added a variable annuity. We feel like the VA space with living benefits is rationalized in the last 5 to 7 years versus what it was in the mid 2000s. So we're back in that game with a competitive product, continually enhancing that to stay relevant. And then we're also looking at things with our RILA product that Ascend has today to make that product a little bit more competitive to be able to get some more traction with our career system, but also in third parties. So that's how I would, say the areas of focus is a little bit about broadening distribution, getting more people to be using us because we're a quality carrier, and then adding some new products that we think will deliver the best solutions for clients and the needs they're trying to solve.
Where do you see the biggest growth? Do you think it's going to be in the variable products, or do you think it might be in the RILA space?
So it's interesting for us because we're coming off a very small base on both of them. We think the
Mhm.
opportunity is both, and we think we're going to be able to, get to really good, comfortable run rates in variable annuities as well as RILA. So for us, it's those two products. In the industry, as you know and you've seen, the explosion's been on the RILA side of things. Variable annuities, the traditional variable annuities, with or without living benefits, is now, less than RILA as a percentage of the industry. We've seen a lot of the traditional variable annuity players get into the RILA space using the relationships and wholesaling teams to drive the RILA growth. And I think advisors do like the RILA story. Obviously, it's getting a lot of traction. So I think there's a continuation there. But I will also say I am a fan of the traditional variable annuity with living benefits. Even as the markets rationalize, those products do play a really good role and provide a lot of value to consumers looking to provide guaranteed retirement income to themselves and their families. So I do see it in that space as opportunity.
So I'll ask you this question, and you may not have the answer to it. Variable products got a black eye in the past.
Yep.
And I think that there's been a lot of changes. Like, what are some of the changes that make the variable products now way better than they were today?
So I'll start on the life insurance side. I think the variable life insurance, the way that it was sold in the past, was part not necessarily just the product issue. It was the way that it was marketed back in the day, and coming from a company that was very variable oriented. My wife and I have really good performing 1995 generation VULs from
Hmm.
Equitable. And if you fund them the right way and you illustrate them the right way and you manage the investments the right way, they, back in the day, were still really good products. Okay. So now move it forward. What are some of the enhancements? I think you've got products now that have been bifurcated. So you have a protection oriented VUL that allows the product to perform as long as a certain level of premium is paid, regardless of what the investment performance is. So I think that has been a big enhancement for folks that want to stick the landing on the death benefit. I think you've seen products that are accumulation oriented so that people know what they're getting into. So that means they're going to fund them the right way. They've got more efficiency, so lower charges. They've got, wash loans after a certain period of time. So when people take money out, they actually aren't also getting friction that eats away at their cash value. And then they've got things like overloan protection riders that will prevent the product from actually blowing up on the
Mhm.
back end, which can create a loss of death benefit as well as a tax event. The final thing I would say, which is pretty cool, is you've also seen companies adding guarantees like the buffer funds or the fixed indexed annuity funds so that a down market isn't also going to impact the efficiency of cash value, right? So I think
Mhm.
though there's been a lot of enhancements, but I will go back. If you bought a product back in the 90s and you funded it the right way and illustrated it the right way, even if it
Yeah.
doesn't have the bells and whistles, it would perform pretty well, right? On the annuity side, I think there's been a rationalization of the carriers that are in the business. So, you feel more comfortable with the companies that are offering these products and the guarantees. I think there's been additions to the investment opportunities in the variable side, like alternatives and things that weren't available to make the product a little bit more, let's call it appealing to certain types of clients. I think you've also seen the same kind of opportunities in the variable products that have the buffer funds and the fixed indexed annuity type funds that are giving people downside risk protection, which I think is great. You've also continued to see evolution in the living benefits and death benefits that are really important for guaranteed retirement income, or if somebody dies early, delivering a certain amount of value to their families, et cetera. So I think the variable products are evolving to continue to get advisors comfortable and interested in them, and then clients feeling good about what they're actually purchasing.
So you guys offer universal life. Do you have index UL?
We do
Okay.
not. We have a no lapse guarantee UL, a single life and second to die.
Hmm.
Our advisors have raised their hand and said, do we want to be in the IUL space? And I would just say that we have taken a pause because of some of the way the IUL products have been illustrated and marketed. We just aren't comfortable, and we would put restrictions on product design, and we would put governors on illustrated rates. And what people would tell us is your product's not competitive, so we wouldn't be
Yeah.
selling it. So we just haven't gone down that path because culturally we don't think it's aligned to what we're trying to deliver.
Which is completely understandable. I know that you guys had started up Haven Life. What's your feel on
Yep.
insurance carriers going direct to consumers?
I think it's interesting. We as an industry need to get to more people because, as we mentioned somewhere in the conversation,
Yes.
and you see it with LIMRA and industry studies, people are underinsured. People are raising their hand that they need more insurance or they just need insurance. The other thing that you and I discussed is the advisor population's right now shrinking, not growing. And that also means advisors are going to go up market, not down market. And that means less people are going to be able to have the advice and guidance they need. So, how do you get to middle market, lower mass affluent? There's a couple ways. You get through them through the group market, through their employers, through
Hmm.
work site at their employers, which we actively participate, and you get to them through direct to consumer. And so I would say we launched Haven. We had a lot of learnings with Haven, both good and bad. We do think it's a viable channel for carriers, now and in the future. As you know, it's a very small piece of insurance in today's market. It's somewhere between depending on the number you see, 3 to 5%. So at this point, we aren't going down that path. We're looking at the work site as the opportunity to get to more consumers that may not be served by advisors. But if carriers and distributors feel that they can get more adoption, like, I'm for it, because I think it's healthy for the industry and it's healthy for the country to get
Great.
more insurance coverage in people's hands.
So, Paul, we've covered a lot, and
Yeah.
what I always like to ask at every interview is there something I didn't ask you that I should have?
That's a great question, and I will say yes. And I thought you were going to ask, and so I prepared a little bit of a narrative. But I would say the narrative is actually in my heart, not in the outline. And so, if you think about the things we talked about with aging population, undersaved, underinsured consumer, more responsibility for people to get to the finish line on their own, generational wealth transfer, etc., I would say the need for advice and guidance in this industry or in this country is going up, like, severely, maybe at an all-time high in our 30 plus years in the business. Now, that being said, the industry, on my mind, isn't at scale delivering on holistic advice. They're
I
using
agree.
financial planning tools to gather assets, put people in a 60/40 portfolio, and think they stuck the landing. And there's been some really good recent articles and research done. I won't name the names, but you can do the research and find them. That basically says the math and the research would tell you advisors and teams that use permanent life insurance adjacent to annuities, adjacent to the 60/40 portfolio, are delivering the best outcomes for clients. And that is in the form of the highest income, longest duration of income, most optimal and efficient wealth transfer, if that's important to the client, and efficiency of accumulation, making dollars work harder for folks. And at scale, that is not happening in the industry. And that is what we think is a differentiator for our advisors, is the understanding of wealth, but staying true to our protection DNA and understanding of how life insurance, disability, and annuities brings a lot of value to people's portfolio, or helping them get to the place at the end of the finish line that's right for them and their family or their business. So that is what I think is huge, is holistic advice, and not talking about it, executing against it. But that means you need expertise and understanding on how to pull all that together and provide the
Yes.
integrated solutions. And that's not widely known in the industry.
Paul, this was a
Yeah.
fantastic interview. I really enjoyed our time, and I think you were fantastic.